to have a recorded lecture is important, all right, because we're moving through a lot of material really fast. And normally, if you were taking this class in undergrad, or even in the PMBA program, like we'd have 3 hours together. And so we're trying to cram 3 hours into 2 hours. And so being able to properly record the content, I have found to be extremely valuable. And I hope that you all have as well. And based on the emails that I have received over the last hour, many of you also feel the same way. All right, so I'm going to kind of go ahead and share my screen here. And again, like if you have questions as we go along, obviously feel free, hit the chat room, raise your hand virtually. I don't know how that works, but just reach out and we will kind of address all of the questions as they come along. All right, but we're going to continue working through Tasha. All right, and I'm sharing my screen here. If there's any issues with the technology, let me know. I'm probably going to be able to cut back and forth between Excel as well as my iPad here to kind of make some notes if you need to. All right, so when we started talking about Tasha, right, when we started really kind of getting into the meat of what the first part of the semester was about, right, we started talking income statement and the balance sheet, and we were developing them based upon some assumptions table, right? Some assumptions table that we started building on. And it started off really simple, tax rate, and then we got into payout ratio and retention ratio. And then we started building into pro forma development, where we were adding a revenue growth rate into the equation. And then Tasha came along and we started layering in a whole bunch of other things when we went through ratio analysis and we started talking about the different liquidity and solvency and operational type financial ratios. And we started working through Tasha. And your first assignment was to kind of build out questions 1 through 4, which got us into taking the assumptions and building out the base income statement, right? And the base balance sheet for Tasha, okay? Which when you did that, everything balanced out perfect. Everything was great. And then we took the next step and we said, okay, now we're gonna forecast the next year based upon some revenue growth rate, okay? And when we did that, the income statement was relatively simple, right? We grew the things that would normally kind of relate to an increase in sales. So obviously sales went up by the growth rate, right? Cost of goods went up by the growth rate because we had to procure more product. Our operating expenses went up by the sales growth rate because we had to incur more marketing costs, or we had to hire new salespeople, or we had to build out our our IT systems to be able to handle the increase in electronic traffic, maybe from our website sales, whatever. But that also increased with sales. We said depreciation went up with sales because we were making the assumption that we were operating at 100% capacity, okay? And when we're operating at 100% capacity, if we want to grow sales, we've got to add to our fixed assets. So we added to our fixed assets at the same growth rate, which resulted in an equivalent increase in depreciation. Interest, we kept flat, right? Because that's a financing decision. Like, we're forecasting the future, but we haven't quite decided how we're going to pay for all of this yet. So we kept interest flat. And then we kept our tax rate at the same rate of EBT. So whatever our tax rate was in our assumptions, we continued to apply that to our EBT. All right, so the tax rate assumption was 21%. And so we constantly took 21% of our EBT. Again, inevitably. And by the way, great job on quiz 2, okay? I looked at the grades this like 10 minutes ago, and you guys all did a great job. So you're clearly demonstrating an understanding of the material. And, I have 100% confidence in what the midterm is going to look like as well. Some of you will inevitably try to grow the tax rate by 5% or 10% or 20% or whatever this growth rate is, right? Don't fall into that trap like we talked about. Keep it at the actual tax rate itself, especially when you get into the new heritage case that we're going to talk about a little bit later. All right, so we did that with the income statement, and then we kind of did the same thing with the balance sheet. You know, all you guys did a great job with all of that. So this is just kind of review. We grew everything that grew by sales, and we came up with this external financing needed. And the case said, split it, give me 50% and apply it to long-term debt, and give me 50% and apply it to common stock. And then we balanced everything out. All right, so perfect. And then we got into question 5. And if you've got questions as I'm going through this, please ask, because I will respond to questions, you know, via the chat room. No big deal. And then we got into question 5, where we started to blow out this project, right? She's considering a new project, and we started creating a pro forma. Okay, and we took the 2021 estimate from the income statement. All right, and we made that assumption that everything materialized according to plan. Okay, and then we said the project was going to deliver an additional 6.5% of sales growth, and it was only going to add 4.5% of incremental cost. And we were operating under a discount rate, or a WACC, weighted average cost of capital, of 10%. And we needed to figure out what that 10 years worth of time looked like. And so in class last week, we kind of blew this out. We took the 6.5% sales growth, we took 6.5% of COGS, we took 4.5% of operating expenses, and then we were told that we had $50,000 worth of new fixed assets that we were going to have to purchase, and we straight line depreciated that over 10 years, which gave us the $5,000 a year of depreciation for the project. Okay, remember, this is for the project and project only. And then we calculated what the interest was, because the case told us, right, that we were taking out a $50,000 a year loan. It was going to be over 10 years at 3.5% interest. And we were able to use Excel's magical wizardry with the IPMT function and the year that we were in to determine how much interest we were actually paying within that given year, okay, to create how much interest the project, all right, was responsible for, not the company, but the project. And then after that, we then calculated EBT, and then we took the tax rate times EBT to get the actual tax consequences. And then once we got net income, we were then able to say, okay, if I'm asking the firm for $125,000, all right, I need to know what the total present value is of all of these future values, right? Because I've got all of these future values. These are all future values, right? So we took the operating cash flow, right, as our first kind of metric for, I'm just making sure I'm recording this. Okay, good. Yes, I am. Okay. As our first metric for like free cash flow. All right. And New Heritage takes it to kind of the next level. Like you're in grad school now. Like if we were in undergrad, we'd stop right here. All right. So this is a graduate level class. So New Heritage, we're going to kind of crank it up a notch and take it to that next level where we bring in changes in net working capital, and we bring in additional capital expense that has to take place every year to make sure the project keeps running. Right. But well, you are in grad school. So we're going to take it to the next level with the New Heritage. All right. So for Tasha, we keep it simple, and then we're going to build on that once we get into the New Heritage case. All right. The undergrad is a 320 class. Like this is where we stop. So we have the discounted, we have the operating cash flow, which we said was EBITDA minus taxes. All right. And then we calculated the discount factor, right, which was 1 divided by 1 plus the required rate of return, the WACC, the discount rate raised to the time period that we were in, okay? And we calculate that discount factor for each one of the years. And then we said the present value for each of these future cash flows, okay, is equal to my future value times my discount factor, which gives us my present value. All right, so we did that for every year. And then we had like what the sum of our present values was. So the sum of all of our PVs, which, oh, I did that a different one. I'm not going to show you how to do that. So this is equal to the sum of the present values, right? Right. So we summed up all of the present values of our future cash flow streams. And then we calculated the net present value, which was the sum of all of our future cash flows brought back into today's dollars, okay, plus the cost of our project, okay? Now, if you wanted to, you could also do it that way, right? And your NPV would just be the sum of all of that, okay? The point here is simply that to calculate the net present value, you take the sum of all your present value future cash flows and you offset that with the cost of the project, right? So you're just adding everything up. And remember, when it says negative 125,000, that's cash outflow. Like that's the cost of the project. You're asking your firm for money. Okay. And so when you ask your firm for money, the firm is saying, okay, I'm going to give you money, negative cash. All right. And in return, you're going to give me positive cash flow. So like we've talked about with the equals PV and equals FV formulas within Excel and how we have to make sure we get the sign right, it's the same thing. You're asking the firm for money. So if they're going to give you $125,000 for this project, that's cash out. And then we get positive cash coming back in. All right. So when we sum all of that up, right, the positive net present value was 36,443. And we said that if the net present value is positive, because we are risk adjusting our future cash flows, right, based upon the firm's requirement of a return, the 10%, that you have to at least give me 10%, because that is where my money is currently invested, and that's what I'm getting. So if you want me to take money out of my pocket to give you the money for a project, you have to do better than where my current money is invested. And that's what the 10% reflects. So we're risk adjusting all of these future cash flows based on our required return. And when we do that, if the net present value is positive, it means that we're delivering more value to the firm by doing this project for Tasha, okay, than we would otherwise be delivered had we kept our money exactly where it is invested based upon our capital structure for debt versus equity. Okay. Then we said, okay, that's great. We have positive NPV. That's awesome. And that's based upon a 10% required rate of return, discount rate, weighted average cost of capital, right? But at what rate of return do my net present value dollars go to zero? So my internal rate of return, okay? How much additional rate of return am I delivering to the firm above and beyond what my requirement is of 10%? Okay. How many basis points above my requirement am I delivering to the firm? So the IRR came into play, right? So the IRR calculation tells us at what rate of return do my NPV dollars, these guys, go to zero? Okay, so we took the internal rate of return using Excel equals IRR, and we looked at all of the undiscounted cash flows, right? Because Excel is going to solve for the discount rate, the required rate of return that's needed in order to force the NPV to zero. And when we do that, we see it's 16.44%. Now we can prove this, right, by using that that awesome goal seek that we talked about, right? So if we want to make sure that NPV goes to zero when our requirements hit 16.44%, all we have to do is do a goal seek. So remember, we went to data and we did what if analysis and we hit goal seek, and we're going to change R58, which is the NPV. We want to adjust that to zero. We want to force NP to be zero. and we want to change our discount rate, right? So if we do this, we ought to get the same number as the IRR. So if IRR is representative of the rate at which we use to discount our future values that creates a 0 net present value, then by goal seeking on the discount rate, we ought to get the same number if we've set our Excel file up properly. So when we hit OK, oh, great, hold on a second. Okay, sorry. When we do this, all right, we're going to adjust the discount rate. We're going to set it to 0, and we're going to change the discount rate. And so what we see now is it automatically adjusted the discount rate. And we can see that the discount rate of 16.44 gives us a net present value of 0. And our IRR is 16.44. And so now they match. And now we've basically proved the theory behind internal rate of return. So internal rate of return is the discount rate that is required in order to set the net present value to 0. Okay. And then we said there was this concept of spread to WACC or spread to discount rate, where we took the internal rate of return and we backed out the discount rate. So how many basis points or cushion, all right, if you will, how much cushion do we have above our required rate of return, okay, in this project? And we've got 644 basis points of cushion between this project and what our actual requirements are of 10%. Okay. And companies will use this. Like some companies will say, like, I need a spread to WACC of 100 basis points, 250 basis points, whatever it is. Like they'll use this spread as a way to translate dollars, right? So when we talked about some of the biases that we have, and we were speaking about like confirmation bias, or the anchoring bias, more importantly, where we think about like the stock market today. I haven't even looked at it in the last couple of minutes, but let's just say like somebody comes to you and says, hey, the market's, like we said, the market's down 300 points today, right? In your mind, it's like, oh my God, 300, that's a big number. But then somebody comes to you and says, hey, the market's down, 0.8% today. All of a sudden, maybe, all right, well, that's not that big of a deal. Right? So we use numbers, but we need to also use things in terms of percentages to kind of give us reference points. So net present value is the primary tool for evaluating whether you do project A or project B. So mutually exclusive projects mean you can't do both. You have to pick one or the other. So NPV is a starting point because it already risk adjusts everything. Okay. And then we use IRR and the spread to WACC as kind of a secondary metric to find out, okay, like that's good, we have positive NPV, but what does my spread look like to my requirements? All right, so we kind of bring the dollars and the percentages into play when we talk about NPV and IRR. Okay, so that gets us to kind of where we ended last class with. Does anybody have any questions about where we're going to start from right now? Any questions? Okay, some of you guys sent me your spreadsheets for Tasha with question 5, and everything looked great. And I will tell you right now, like we talked about last week, you're going to spend 1/3 of your time getting the right numbers. You're going to spend 2/3 of your time formatting everything properly. Okay. And the files that I got over the last couple of days with question 5 and everything laid out look awesome. Okay, it looks fantastic. All right, so let's move into the next 10 or 15 minutes and let's talk about the payback period and let's talk about profitability index, because that's something that you're going to need to solve for when it comes to the new heritage case that you guys are going to start working on. And I did get a few emails with some confusion about the Excel file for how to use it, and you guys didn't quite understand what you were being asked to do. So we're going to go through that today. And I didn't mean to not give you that information last week. I was intending to also provide it today. All right, so we're going to go through that here in a little bit. So let's talk about the payback period. All right, so the payback period is kind of the third metric that is used in not even really evaluating whether you're going to do a project or not, or implement a project or not, but it's a number that financial managers will sometimes look at just to kind of get a feel for how long is it going to take me to get my money back. Okay. And if we're talking about how long is it going to take me to get my money back, we tend to look at that through the lens of undiscounted cash flows. Okay, so I'm spending $125,000 today, and your project is going to give me, this stream of cash flows in the future. Like, when's my crossover point? Like, if I give you this money, like down the road, because as I move through 2022, 2023, 2024, and I'm in 2025, right? These are dollars that are going to come in 2025. So if you're thinking 5 years down the road, 4 years down the road, 10 years down the road, and you're in that period of time, those kind of become present value dollars, right? So we look at payback period with undiscounted cash flows. Okay, so when we're talking about the methodology for going through calculating the payback period, we start with the undiscounted cash flow. So we're looking at all the cash flows that are undiscounted. Okay, and what we're trying to find is, where is that crossover point? At what year in the future, okay, do I finally recoup all of the money that I spent, the $125,000. So we have to calculate this cumulative operating cash flow. Okay, so we're basically, every year that goes by, okay, we're essentially adding the next year's worth of cash flow to it, so that we finally find out at what year do I flip from being underwater to finally having paid off this initial amount of money that I have shelled out. All right, so when we do that, it's just nothing more than equals the sum of that. Okay, and anybody else know what I'm going to do next? Or we can do it even simpler if you don't want to do that. So equals that, right? So the cumulative in year one is just that, and then the cumulative would just be equals the year prior plus what we brought in. Okay, so after our first year of operations, right, we brought in $26,401 undiscounted dollars, and we had shelled out $125,000 in year zero, and so we still have to now recoup $98,599 before we cross over from being underwater to being in the money. So now that we've set this up properly, we can just drag it. Right, so in 2023, we're still underwater. We still have $72,229 of our initial investment to pay off. So on and so forth until finally, boom, here in 2026, okay, we went positive. Okay, so sometime in 2026, right? Sometime in 2026, we went positive. Right? Now, when in 2026 did we go positive? That's the question, right? So here's a question to you guys right now. If you look between 2025 and 2026, okay, so here and here. So in 2025, we did these operations, right? And in 2025, we still had $19,587 left to pay off at the end of 2025. But by the end of 2026, we had gone positive by 6682. So let's test your knowledge. We had 1 year, 2 years, 3 years, 4 years, and sometime in the 5th year, we repaid all of what we had shelled out. Okay, so we know that at a minimum, we have 4 years and something, right? So how do we figure out what the fraction of a year is out here? Anybody got any ideas? So how much did we have to recoup in 20? How much did we have left at the end of 25 that we needed to recoup in 26 to get us to 0?
$19,587.
We had 19,000. Who said that?
Michael.
We had $19,587, right, to get to 0. And in 2026, we had projected we were going to deliver 26,269. So clearly we were offsetting all of the remaining 19,587 during some portion of 2026, right? So if we take the 19,587 that we had to recoup, and we divide that by the total value that we were going to deliver in the entire year, then it tells us that during the course of 2026, we paid off that 19,587 at 0.746% of the year. And I'm going to stop there for a second and let you guys think about that and ask questions.
Professor, on the exam, would you want us to leave it in that decimal form, or would you want us to like multiply that by 52 to get like 4 years and some odd weeks?
No. So it would just simply be, 1, 2, 3, 4, like 4 plus this number.
Okay.
All right. So 4.7456 years. Okay. Now, this is going to be very helpful for you on the New Heritage case. Okay. Because New Heritage asks you to calculate the payback period. Right. And this is how you're going to do it. Can I show the formula for division again? Sure. So you have to figure out at what point in time, right, do you cross over? So we're repaying the initial investment, right? When we have negatives, we're repaying the initial investment. We're repaying, and then finally here in 2026, like we've repaid all of our investment and we finally have positive undiscounted cash flow coming into the firm. Okay. The question now becomes, at what point in time during this year do we actually cross over that 0 threshold? Right? And so we have to figure out, okay, how much money did we need to repay in this year, okay, before we kind of hit that 0 marker? And we know that we have to repay the 19,587. Once we repay that, we hit 0. So at what point in time during 2026 do we or have we generated 19,587 operating undiscounted cash flows to get to zero? Okay, so we take, and I just put a negative in here just so I'd flip the sign, right? Because I need positives over positives. Okay, we're generating 26,269 undiscounted cash flow dollars, and we need 19,587 to hit our 0 point. So we take the 19,587, we divide it by the 26,269, and that tells us that it takes us 74.6% of the year to get to 0. And then everything beyond that contributes to the 6682 of positive, right? So you can look at it a different way. And you could say for 25.4% of the year, all right, for 25.4% of 2026, the back end of 2026, during that 25.4% of the back end of 2026, I'm delivering positive cash flow to the firm that has 100% fully offset my initial investment on an undiscounted basis. Okay, so that's another, just kind of looking at it through a different lens. Tim, does that answer your question?
Yeah.
Great. Okay, so the total payback period is, 1 year underwater, 2 years underwater, 3 years underwater, 4 years underwater. So your base is 4, and then 4 plus whatever you calculate as the fraction of that last year, 4.756. So your payback period is 4.756 years. Now, to the other question, yes, I could ask you a question. I could ask you to give it to me in weeks. I could ask you to give it to me in days. You guys are smart enough to figure that piece out. But the math is 4.7456 years. Okay. Any questions about that?
I have a question. If you
Go.
were to ask in weeks or days, are you dividing it by 5 or by 7 based on like business hours?
Okay. Reframe that for me. Say that again.
Sure. In operations, when we use any kind of type of calculations for weekdays, we use 5 because there's 5 days in a work week. Are we talking about payoff period? Does this happen through the weekend, or does this happen only on working hours, business hours?
You know what? As you guys will find out when you leave the walls of academia, you work 365 days a year, even when you're on vacation. So this is based upon 365 days a year, 7 days a week, 24 hours a day.
Great, thank you.
Yep, no worries. So it literally will take, this is literally 4.7456 years. Okay, with including every single day of the year. Okay, good question. Good question. Right? Because that is different based upon some of the assumptions within your operations classes. Totally appreciate that. But in the real world, especially when you guys start working, you really don't get any days off. Sorry. Okay, so let's talk about, so everybody cool with payback period. All right, let's talk about profitability index. All right, kind of it's not so much a decision-making criteria, all right, but it is a metric that is just something that we provide to senior management to give just another variable to compare one project to another project, right? And the profitability index is how many incremental dollars and cents on a discounted basis is my project, your project, delivering above and beyond the dollars that you're asking the firm for your project. Okay, so when we look at profitability index, we're looking at the sum of the present values, okay, of all of those future values, future cash flows that your project is going to deliver. Okay, so all of those discounted future values, the sum of all of that, compared against how much money you're asking for. So when we do this, if the profitability index is nothing more than the sum of the present values, okay, divided by, okay, the project cost, right? So we kind of want to keep positives and positives, get rid of the negatives. So we're going to do negative project cost. Okay. And so for Tasha, this project is for every dollar, okay, for every dollar of money that you're asking the firm for, okay, this project that is being evaluated is going to deliver $1.29. Okay, so the profitability index says how many additional dollars or cents in this case is the project delivering to the firm on a discounted basis, so apples to apples, above and beyond the money that you're asking the firm for today. So Tasha is delivering 29 cents of extra value for every dollar that she's asking for. Right? So it's just another metric. So when in New Heritage, you're going to be asked to calculate the profitability index. Right? So for every dollar that Tasha gets of this 125,000, she's delivering $1.29. Okay, so 29 cents more than what the current money is invested at. Anybody else want to take a spin on how you could rephrase that in a different way? In terms of like rate of return? Just think about it. Okay. So in terms of the midterm and in terms of New Heritage, what we've just talked about between last class and this class with net present value, IRR, spread to WACC, payback period, profitability index, you guys are good to go, right? There's nothing else more that we need to talk about as it relates to those two upcoming endeavors. But what I do want to do is take just the next couple of minutes to give you additional insight into what goes on in the real world. Okay, because sometimes you'll engage in projects or transactions, deals, if you will, right, where a certain percentage of the free cash flows, okay, keeping it simple, operating cash flows, okay, might get retained by one party over the other until a certain IRR, internal rate of return, is achieved. Okay, so we did this quite a bit within, Constellation Energy years ago, where we use a concept called flip IRR, where we would be willing to invest money in a project, but in return, we get a larger slice of the pie until some target internal rate of return is achieved. Okay, so we call this kind of the flip IRR. And, we can look at this and we can say, and this is just for your knowledge, okay, that you're not going to be tested on this, but this is just for like your knowledge in terms of figuring out like how things actually get done in the real world. And not every company does this, but there are lots of deals and lots of transactions that do get done based on a flip IRR basis. So when we looked at the IRR, right, we said, give me the IRR for the entire project. I'm spending this and I get this in return. Tell me what rate of return is being delivered back to me. Okay, that sets my NPV to 0. Okay. So we can look at a situation, okay, where we look at the IRR just kind of for year one, right? We could look at that and say, oh, that is a terrible internal rate of return. Okay, but we know that this project is going on for 10 years. So we can look at a continual IRR, right? And if we look at here to the final year, I'm going to blow this out to 2 decimal places and it better equal 16.44%, right? So this better equal, there we go. All right, so at least the math works. So we're kind of creating this cumulative internal rate of return, if you will, okay, as the years go out, right? Because we're fixing that first year, the initial cost. Okay, and so some companies will look at this and say, look, until the internal rate of return, let's just say, is 11%. Okay, until the internal rate of return hits 11%, right? So all of these years, if I'm going to give you this $125,000, think private equity firms. Okay, if I'm going to give you money for your project, for your startup, for your new business endeavor, right? I want as much money as I can get back as quickly as I can. Okay, amortization tables, the banks, you pay more interest up front because the bank wants their money quicker. Okay, that's why the interest is higher on the front end than the back end. So firms will say, like, I've got a flip IRR of 11%. And until that 11% is hit, I get 100% of the profits, or 80% or 90% or whatever the split is. They get the vast majority of the profits for giving you the $125,000. Okay, so we can use IRR as a way to structure deals. Anybody have any questions about that? Bueller? Bueller? Nobody. Okay. All right. But if you look at the flip and you look at the last year, the 16.44, the IRR naturally must equal the IRR from what we calculated before, because it's the exact same math. Can I see the cell formula for S68? S68. Okay, so we're designing Excel, right? We are using Excel to our advantage. So all we want to do is we want to set this kind of cumulative IRR formula up one time. So we have to fix it. So we're always referencing the money we're shelling out, right? Because we're referencing everything back to that. What rate of return do I need in order to set the NPV to 0? Right? So we're fixing that initial investment, and then all we're doing is adding to it the next subsequent years. I guess I should go this way. The next subsequent years. Okay, so when we do that and we fix that initial investment R54 using the dollar signs, and we float the S54, all right, we can then just simply drag it where we want it. Okay. All right, questions about profitability index, payback period? Everybody 5 by 5. Okay. All right. So why don't we try to work through some problems together? Okay. I'm going to bring over, connect to our shared screen. And let's work through some of the chapter 8 problems. Okay, dealing with net present value, profitability index, payback period. Give me 30 seconds here. So go ahead and fire up your Connect, okay? And grab this and haul it over here. All right, and let's start working through question 1. All right, we'll just start at the beginning. Okay. Well, that's terrible. Let's go to some actual Excel problems here. Okay, question number 8, question number 9. All right. And your numbers may be different than my numbers. That's at least one of the, positive things. What's that?
The chapter 8 problems are not on, or at least I can't see them on Connect.
You have to do
Alright.
it.
Yeah, the problem is we have to do the first 7 in order to access 8.
Okay. Well, then let's just work off of my question 9 that I can have access to, which will apply to your question 9 that you can go back and do later. How about that? There's trade-offs and everything. We talk about opportunity cost, right? And Connect is, it can be a very functional tool when it effing works. But when it doesn't, it's very frustrating for both you and me alike. So my apologies for the issues that we had over the weekend with the chapter 5 problems as well as the quiz. So okay. So let's just work through, question number 9 here, all right, on mine, which will be the same as your question 9, okay? But just with possibly different numbers. All right, and I've already sent a note to Connect, by the way, to see if there's a way that you guys can just simply pick whatever question you want to start working on and do those first and then go back to the other questions. And I haven't gotten an answer back yet, so apologies. So here we've got a company that's evaluating all of its projects based upon using the IRR rule, all right, which is not the ideal way of doing it. We always start with net present value. Net present value is always the first methodology that we use to evaluate whether or not we take on project A or project B. Okay, because both project A and project B have already been discounted by each project's respective required rate of return. Okay, we've already layered in the appropriate level of risk using the discount rate or weighted average cost of capital. So net present value is always the first criteria that we look at. Okay. We go to IRR next because sometimes we want to see what the spread to WACC is, right? So in this case, the firm is saying that their decision is to use IRR as their deciding factor. Okay, and they want to know what the project's internal rate of return is. Okay, so we have a stream of cash flows. So if we're using Excel, like you should be doing, all right, and again, this is personal preference, but I tend to see time. They have the year showing in the rows here, a single column with all of the time. I tend to see time in columns as opposed to rows. However is most comfortable to you, that's what you do. All right, but I've got 0, I've got 1, I've got 2, I've got 3. Okay, and I have an initial outlay of $147,000. And I'm getting something in return, 69,000 in year one. I'm getting 70,000 in year two, and I'm getting 54,000 in year three. Okay, and I want to know what the internal rate of return for this project is. So we do it the same way that we just talked about with Tasha, right? These are obviously undiscounted numbers. These are future values. And so we just say equals IRR, okay? And we highlight everything and we're done. All right. And there's our 15.61, same thing that we've got in the answer. All right. If you've got questions, just hit the chat room, okay? Because I'll answer them as we go along through all of these different problems that we're going to work through. So hopefully you're on your computer, your device, whatever it is right now, and you're kind of working through this, right? If I'm going too fast, ask me to slow down so that everyone can kind of catch up, okay? All right. So again, question 10. We have a time period, 0, 1, 2, 3. We have some cash flows. And I'm doing each one of these kind of discreetly, if you will. You can obviously see that there's a way to set this up so that you only have to build it one time and then you just change variables to kind of go through. But I'm just kind of do it discreetly, problem to problem, if that's okay. 53,000, 86,000, 70,000, right? And now the question says, okay, so for part A, it says at a required return of 9%. So our weighted average cost of capital is 9%, our required rate of return is 9%, our discount rate is 9%, whatever the terminology may be, because we use it interchangeably. What's the net present value of the project? Okay, and I'm going to just cut over to my iPad here real quick to go through this. Everybody see this okay? Everybody see that okay? Okay, okay. So remember, we talked about future value is present value times 1 plus the rate to the time frame, right? And then we rearranged everything and we said present value is equal to future value over 1 plus the rate to the time frame, which was also equal to future value times 1 over 1 plus the rate to the time frame. And we said that all of this was the discount factor, right? So we're kind of stepping through the logic here. So now we've got to take all these cash flows and we've got to use the discount rate, the required return of 9%, and we have to bring it back into today's dollars and sum everything up and find out what our net present value is, just like we did with Tasha. Okay. So let's do that. All right, so we've got the cash flows. We know the discount rate. Just giving myself some more space here. And we know it is 9%. Okay. And so now we just got to bring these future values into present value. So we need to calculate what the discount factor is. So equals 1 divided by 1 plus our rate to the time frame that we're in. And then we can just drag it. So clearly these are FVs and we need PVs. So equals our future value times our discount factor. Right. So now we've successfully brought all of our future cash flows into today's dollars based upon our required rate of return. And our NPV is nothing more than the sum of everything. Okay, so 12061 spot 18, 12061 spot 18. Okay. And once you've got this kind of general format set up, part B becomes really easy because now part B says, now maybe this project is a little riskier than we initially thought. And so now, like, if I'm going to give you $163,000 for this, go ahead.
Can you please go back to the cell for the discount factor? That went really fast and then you lost me after that point.
Okay, so we've talked about how the present value is equal to the future value times the discount factor, right? And we came up with this term discount factor because we took the future value divided by 1 plus rate to the time frame, and we broke that apart into two pieces. And we said present value is equal to future value times 1 divided by 1 plus the rate to the time frame. That variable is the discount factor. So within the Excel, it's simply 1 divided by 1 plus my rate raised to the time period that I'm in. I'm in the 0 time period. Okay. And by using the dollar signs, I'm able to fix my rate because I don't ever want that rate to change. I'm going to constantly use 9% for all the future years, but I want my year to float, so I don't put any dollar signs around my year. And when I do that, I can just click and drag, and then I've got my discount factor for every year. You want me to go back to my iPad and redraw it?
No, it's okay. Like you just went over it really fast and I didn't have the cell in there correctly.
You got it now?
Yes.
Okay. All right, good. All right, so now part B says, okay, now your project, it's become a little bit risky for us. So we're going to risk adjust your project by changing our required rate of return. So instead of 9%, now part B says it's 19%. So now I can change my discount rate to 19%. And it automatically changes my net present value. Questions? Everybody get it? Okay. I'm going to assume that silence means everybody understands what's going on.
Can you just give us a second just to catch up?
Go ahead. Say that again.
Just how do you get the NPV?
Well, net present value, okay? So net present value is the sum of all of the present values, right? So the sum of all the present values is the sum of all the present values. So once we bring everything back into today's dollars, we're trying to figure out, does this project deliver more value to me than where my money is currently invested? So at a rate of 9%, like your treasury department okay, has looked at the debt and equity capital structure of your firm, and based upon how your money is currently invested, you're earning 9% rate of return. So if you want your company to give you money that they're currently earning 9% on, then you need to deliver something above and beyond 9%. Otherwise, they're just going to keep the money where it's currently invested. So we have to figure out on a present value basis at a 9% rate of return, how do those future cash flows, these guys, okay, compare to what you're asking the firm for? So you're asking the firm for $163,000 today. So in today's dollars, at my requirements, how much are you giving to me? How much are you bringing back to me from your project? And you're bringing back $170,061, $175,061. And that $175,061 of present value dollars 100% offsets what you're asking me for and over delivers by 12,061. That's the whole concept of NPV. That's why we use NPV as our primary decision-making criteria. Okay, we good? Okay. So here's what I want to do. This is kind of, I don't know. Let's talk about the midterm for a minute. All right, and then we'll get into New Heritage. All right, so here's your midterm. This is actually actually your midterm. Okay. So as promised, your assumptions table is exactly what you've seen by working with Tasha. Okay. So there's two deliverables. There's the first deliverable, which will be due on March the 1st. The second on March the 3rd. There are drop boxes on Moodle for both of those assignments. Day one, you should be familiar. Okay, this is what we just did with Tasha. Got to build the income statement, build the balance sheet. You're going to use the growth assumptions to build pro formas for the income statement and the balance sheet. You're going to calculate the external financing needed, and you're told you're going to plug long-term debt. Okay, so no 50-50 split. You're just going to plug long-term debt. You're going to calculate the projected CFFA using both of the methodologies and determine whether the identity holds. And then you're going to calculate the internal growth rate and the sustainable growth rate for 2021. And then answer the question, is it feasible for them to grow at that rate? Why or why not? Okay. And so for day one in Excel, in the Excel file, I've already made your life simple, right? So if you want to print this out and make notes, just go to print. Okay. And it's already, everything's already set for you. All right. I did some work for you. So if you want to print it out, all you got to do is print it. You don't have to set page margins or anything. And then, okay, what you will submit on the first for day one, the first part is exactly this. So we did this with Tasha. You got income statements, actuals estimated. You've got space for the CFFA and the IGR and SGR calculations, ROA, ROE. You've got an out of balance projection for your balance sheet. You've got an EFN calculation, and then you've got an imbalance projection, and then your response to, can they sustain the growth projection that they've made? Okay. And then again, all you have to do is print it, save it as a PDF, upload the PDF to the Dropbox. All right, everything's already done for you. And for day 2, all right, we're going to go through the same thing that we just did with Tasha with a project, right? You've got a growth rate. Okay, you've got a growth rate. I've got one thing. I got to change one number here so that everything aligns, but it's just not available to you yet. I'm within like 15 minutes of finalizing it. All right. You'll have growth rates. You'll have added SG&A expense, required rate of returns, fixed assets, straight line depreciation. Everything you've done with Tasha is exactly here, just different numbers. All right. And then in day 2, it looks exactly like we've just been working on with Tasha. All right. So once day 1 closes, okay, because after day 1, right, you will have kind of come up with this 2021 estimate for the income statement, right? Maybe it's right, maybe it's not. I don't know. But if it's not right, then a lot of what you're going to do down here is going to be wrong. So on day 2, once day 1 closes, I'm going to give you the exact numbers for 2021. So I'm going to give you the perfect starting point because I don't want any of your potential flow through errors to carry over to day 2. So you get a clean slate for day 2. All right. And then you're going to build the projection just like we just did with Tasha. Right. And you're going to give me the cash flows, operating cash flows. You're going to give me the discount factor to 4 decimal places. You're going to calculate what the present value is for all the years, just like we just did. You're going to give me the sum of all the present values and then calculate the net present value, which is just the sum of all of the present values, including the cost of the project. You're going to tell me what the IRR is. You're going to give me a spread to the WACC. And then in the case, it tells you that she's also considering, or SNS Air is considering, a second project, okay? So you're going to tell me what the NPV of that project is, the IRR of that project, what the spread to the WACC of that project is, and then you're going to tell me which project does SNS Air choose to do. Right? And then again, because I love you guys so much, I've already set your print margins up, so all you have to do is print, save as PDF, and upload to the Dropbox. Right? So you can see that this is exactly what I've told you that we would be working towards since the very first lecture that we had together. And setting up your Excel file and getting things lined out, because now you're ready to go. Any questions about the midterm? Now's the time to ask. No?
Yeah, I have a question. When you say plug long-term debt, does that mean we're gonna get an EFN that's not 0? Are we plugging it into the one that is, I mean, I guess it will. But
So like with Tasha, right? With Tasha, okay? With Tasha, the case said plug long-term debt and common stock with 50% of EFN each, right?
yeah,
And so we took the EFN, we took half of it, and then we shoved half of the EFN into long-term debt, and we shoved half of it to common stock to force the balance, right?
okay,
So in the case of the midterm, I'm telling you, just plug long-term debt. Whatever EFN you calculate, plug it all here.
got it.
Other questions?
Yeah, I also have another question. If this ends up mattering, is it better to get returns faster or in the future? Or
Right,
will
so
that not matter?
Say that one more time.
Sometimes when there's like debt compounded, like debt goes down in the future. But if our comparison at the end, the very last question for day 2, is that gonna be something that's about when you're gonna get the money back or how much you're gonna get it back in general?
Okay, so question 7 revolves around the project valuation and decision-making criteria, right? And so you're going to be calculating some net present value based upon the numbers that you come up with for a 10-year pro forma. Okay. And you're going to have a net present value for project 2, right? And we've talked very clearly about the fact that net present value is the primary foremost decision-making criteria that we use in determining what mutually exclusive projects we will take on, right? Because each project gets evaluated at each project's own respective discount rate, which is a risk-adjusted discount rate. So the risk of the project is inherently tied to the discount rate that is used for the projects that are being evaluated. So if we're using each project's respective risk-adjusted discount rate, and we're calculating a net present value, and we're comparing project A to project B, then the project that delivers the most net present value dollars is the project that we do. So you're going to calculate an NPV here, and you're going to have an NPV here, and you have to decide which project you're going to do. So I'm not going to give you the answer to that question, but I think based on what I just said, you kind of get the gist of what I'm saying.
Definitely, thank you.
Okay, so here's what I want to do. I'm going to give you guys some time. I'm going to stay on. I'd like for everybody to start kind of going through the chapter 8 problems on Connect. All right. And I'm going to be here because this is what I would have done in class time anyway. I want you guys to start working on the chapter 8 problems within Connect. All right. And, you know, the first, where's my little thing here? Hold on a second. You know, the first 8 questions are basically just multiple choice questions. You should be able to answer all of those questions within, 5 minutes. And then we're going to get into more of the algorithmic questions from questions 9 through 15. So you guys work in your groups. I'll be on. I'm not going to leave you guys, but let's just start working through chapter 8 problems. And if you've got questions, let's work through them together as a group. All right, sound good? Question 11. This one?
Yeah, what would the Excel, what does your Excel look like? Just the setup to solve that.
Sure, we can work through it. Okay, so let's work through it here. All right, so we know we've got a project that's going to, and again, my numbers are going to be different than your numbers. Okay, Connect just kind of tosses everybody different numbers. All right, so we got a project that's going to provide some, even though they spelled provide wrong, annual cash flows of $3,100 for 9 years, costs $10,400 today. All right, so let's just translate words into Excel. So we know we've got something today, so that's times 0, right? And then we know we've got 9 years. Okay. And so the project, the project is going to cost $10,400 today. Right, so we know in time 0, that's a negative, that's a cash outflow of 10,400. And it's going to deliver annual cash flows of $3,100 for 9 years. Okay. We know, we're told that our rate, our discount rate, our WACC, our required rate of return is 12%. So we want to know what the NPV of the project is. Right, so we've got our future values, right? We need our discount factor because our present value is discount factor times future value. So we just now need to calculate our discount factor. So equals 1 divided by 1 plus our rate, which we're going to fix it because we want to be able to drag this formula to save ourselves time. And we're going to raise that to the time period that we're in. And now we just drag it. So now we've got the discount factor for every year. And so now we need to calculate the present value for every year, which is equal to the future value in those future years times the appropriate discount factor for the respective year. Okay, and then the NPV is simply nothing more than equals the sum of all of our present values. And so we've got 6117 spot 57, and we've got 6117 spot 57.
When you do the NPV, do you include the initial investment, the cash outflow, or do you only include cash inflows? Okay.
You always include, you have to include the initial investment. Otherwise, you're just summing present values.
Got it.
Why did you ask that question?
Just in case the net present value was talking about the return exclusively, not the return that covered for the outflow. Thank you.
So, all right. So I used to bring into this course the Excel function NPV. Okay, because there is a function called equals NPV. Okay, where you give it the rate and you give it the values and it does its work.
Mhm.
But there's something that the way the Excel function for NPV works is not the same technical definition of net present value, because when you do this, all right, and you do N equals NPV and you put in the rate, okay, and you have to put in just the positive cash flows, not the actual project cost. When you do that, it'll give you the sum of all the present values of these guys, right? So if I just sum all of this stuff up, 16,517 spot 57, 16,517 spot 57. But the true financial management finance definition of net present value also includes the capital cost of the project. So some of you may have found the equals NPV function in Excel, but you then, before it's 100% correct, you then have to include the cost of the project. And then your net present value is 100% right. Okay, so net present value purely definitionally, okay, so not from an Excel function equals NPV standpoint, is the sum of all of the present values of the project, which obviously would include that present day cash outflow to get the project off the ground. Does that make sense?
Yes.
So don't get confused. NPV is the sum of all of the present values for the project, including the money you're asking your firm for. And then if you've set, kind of your Excel file up properly for question 11, part B says, you've got a change in the required rate of return of 28%. So you just simply have to change the 12 to 28 or whatever your number is, and then it automatically flows, right? Everything changes. So NPV of negative 528.94. There it is. And then part C says, at what discount rate would you be indifferent? What does that mean? At what NPV dollar amount am I kind of sitting there going, meh? Zero, right? Zero. Who said that?
Jeremy.
Great job, Jeremy. Zero, right? When we're at an NPV of zero, we're kind of indifferent. Like, I don't know. I'm happy where my money's at. It's doing what I need it to do. And it's kind of a real pain in my ass if I want to move it out of where it's at to go put it into your project, because it's not really delivering me any extra value. So the question now is, at what discount rate am I indifferent? So goal seek, right? Goal seek. If you've set your Excel file up, part C is a piece of cake. Data. What if analysis? Goal seek. I want to set my NPV to zero, and I want to change my discount rate. Bingo, 26.11. Right? There it is, 26.1, 26.1. That's the point at which I'm indifferent, because now my NPV is zero. Learning how to use this greatest gift to man is going to save your life. And this was recorded, by the way, so you guys will have a chance to go back and kind of watch that goal seek thing again. Does that help?
Yep, that helps.
Because otherwise you're kind of just like trial and error. You're just going to be changing this discount rate 100 times before you get close to zero. This is as close to zero as Excel is going to get you. Okay. And if you're going through and you go and you get all the detailed feedback, right, about your responses, and the way that the responses come in, like they're showing you the textbook way of doing it. And the textbook uses like annuity tables and annuity factors, which you can do that, but I'm trying to teach you the most efficient way, of getting at the answers using Excel as your primary form of analysis. Or if you have, I use an HP12C calculator quite a bit, and you can also you can do it that way if you're comfortable that way and you know how to do it, but still Excel it will beat the pants off of that every day. Okay, so the midterm is going to be released as soon as we finish our chat. All right. The new Heritage Excel file is out there. Again, I would encourage you to use that as a resource to kind of start solidifying some of this knowledge around NPV and IRR and payback period and profitability index. All right. I am available this week to answer questions that you have regarding anything about Chapter 8 problems on Connect. The slide deck for the chapter is on Moodle, right? I hope that you've appreciated like not being lectured from a slide deck and actually taking just real numbers and real scenarios and putting it into Excel to try to find out how it works. Your feedback on that is always appreciated so that I can adjust as we go into, the next half of the semester. But reach out if you've got questions. The submission folders are already up on Moodle for day 1 and day 2 of the midterm. If you've got questions, just reach out, okay?
Thank you.
Okay, all right, well, that's going to be it for today. I'm going to go ahead and just kind of stop the recording now. But